Boom, 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 boom. Testing, testing, 1, 2, 3, testing, 1, 2, 3. It's almost 12 GMP. We have a monetary policy committee announcement. That comes out in just a few minutes. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that gives Forex traders access to the Forex market. But we also have gold and oil and stock indices from around the world. Everything you need to make life beautiful and perhaps even profitable. I have a little window here that's supposed to broadcast from the Bank of England. But that ain't going yet, so we'll see what happens. At 7:30, I'm doing a webinar at Forex.Today. Feel free to visit Forex.Today and register. Just click on live at the top of the page. While you're here, please subscribe to the YouTube channel for Forex.Today. Would you do that? You can also, if you're here live, type something into the chat room. I'm watching. I'll respond. So anyways, we'll see what happens. This was actually kind of a difficult link to get from the Bank of England. I guess they don't report them very well. So let me get off Aussie yen. Look, I'm going to put something into the chat. Good day. And I guess we should go to a pound scan. Less than 1 minute. Super Thursday to you. All right. Pigs already, Oscar Mike. I'll refresh this page. So good morning, Ben. Good morning, John. Good morning, Paulo. So I don't know what's going on there. I'm just waiting for that. So currently we have CAD stronger than pound, yen stronger than pound, Swissy stronger than pound, Aussie stronger than pound. Seems like pound is weak. Still nothing from this page. Something's happening, yo. Something's happening. No, something's not happening. Look like the page. Again, I'm watching a page on the Bank of England that's supposed to be showing this thing. It's a live webcast that hasn't started. Other than that, how's it going? Look at this pound Swissy really taking a move on the 5-minute. I think we should probably move things to 15-minute charts. Just sort of take an intraday. I'm going to assume you've already done your analysis on the higher time frames. And refresh the page again. So we'll just let this run. Weekly central on the beast here, 71.21-ish. Look at that, just boom, came down. Nice little bounce here. Bounce with me. Bounce with me. Okay. Big reaction off the pivots. Question is, you need to, well, you kind of need to know what you want to do with this now, because you can't make decision on this type of price action. It's moving pretty quickly up or down. So like if you were a bear and you wanted to sell this anyways, this would probably somewhere between this 70 and 00 on the beast. You know, same thing. Look at here on the pound Swissy. This old resistance may act as resistance again if you're going to do it price action. Next level would be up here. And refresh the page again. No. Starting to feel a little dubious. All right, so let me, I'm going to go to a different source then if they're not going to do their job. Shocker. A central bank with not an up-to-date website. So let me get you some more information then. Okay, so they voted 9-0 to keep interest rates the same. That's not really a question.
Next move likely to be higher than not, so maintaining that view that the next move will be higher.
All right, so they're not going to lower interest rates. And just trying to get some more details. The inflation report, which is what they're supposed to be talking about now, right here. Webcast status preview. Still preview. What's the deal? All right, well, I guess we'll just sit here and wait. All right, so let me tell you what I know now. Cut 2016 GDP from 2.5 to 2.2. So that's not good. Cut 2017 GDP from 2.7 to 2.4. Saw CPI at 1.25 in 1 year. Okay, that's fine. Saw CPI at 2.05 in 2 years. That's about the same. Saw CPI at 2.25 in 3 years. So a 51% chance. I like that. 51% chance. 51% chance. Just wait. So a 51% change in CPI at or to. Hang on. I think it's just misspelling. So a 51% chance of CPI at or above 2% in 2 years. All right, fine, whatever. So no real massive change here. So it doesn't look hawkish. It looks fairly dovish. Things have been revised down, but they're trying to, I don't know, they're trying to play it like it's not so bad, but it's not so good either. So if you're going to play this bearishly, I think is probably the way to go. Let me go back to the comments that I did right after the initial announcement, right? That's the resistance to sell, and you can see that's come down. Oops. And then go into the other one, the beast that I talked about. I was trying to point out, I think we're about here. Let me put pound dollar on here. I'm going to put it up here. Okay. This one's a little trickier because there's no, on this time frame anyways, reasonable prevailing trend. Oops. Come on now. Right? Because I would mark this. I don't even know how to mark this. I mean, resistance. Okay. I get that. I don't know how you'd play this. Maybe here. Do, 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 do. Game plan probably something like this. What do you stink? Still nothing. I'm waiting for this webcast. That's what I thought we'd be watching right now. Still in preview mode. I'm going to review the bank's website. Watch the conference. Yeah, no, I'm on the right page. I thought the well, whatever. Let me read you the actual report then while this happens. Come on, I don't need the whole page. Yeah, so interesting, huh? Do you guys want the actual link to the report so you can read it yourself? If so, just let me know in the chat room. At its meeting on February 3rd, 2016, the MPC voted unanimously to maintain. Yep, great. December 12-month CPI stood at 0.2, almost 2% below the target rate. And yet they think, at least they're telling us that they believe it's going to be like 2.0, 2.2, 2.4. What? How can it be 2.4 when we're at 0.2? Pretty bad, huh? Oil prices were more than a third lower in sterling terms than a year earlier. Together with muted growth in world prices, the appreciation of sterling since early 2013 has pulled down on import prices more broadly. Good. So they talk about Forex and commodities right off the bat. Not even talking about their economy, huh? Yes, that is pound dollar. Yes. Are you not able to see the prices clearly? Everything go right then? Global growth has fallen back further over the past 3 months as emerging economies have generally continued to slow and as the U.S. economy has grown by less than expected. All right, so okay, fine. Well, no one wants the report. All right. I'm going to check the. See, I thought we were going to actually be watching the webcast, but they're not webcasting. Look, I keep refreshing it. It's still in preview mode. I went back to the homepage, the Bank of England, got back to this page. So maybe someone over there forgot to press the record button or something. Oh, Alistair, press the button. Oh, quite right, quite right. So, anyways. So let's go back. Anyone going to take a second chance shot? Right. This would be a sell zone. I try not to lose it all. In the end, it doesn't even matter. Look at this one. Really bounced off my zone here. Yeah, see, this is trickier because there's a bottom and a top, but no higher high, no lower low. You know, I'm not even sure if it has the ability to play the top end of the cycle. But when you set this up as a trade, selling it in the middle feels just terribly wrong. Right? So like some people would treat this like a retracement and sell it, right? Like a 382 and then sell it low. I don't like that. I don't like that because you're in the middle. So if anything, you know, we're going to stay right there. So we'll be careful. But this maybe isn't a whole lot better. Let me go back to this one. This one seems to be the best setup, pound Swissy. Well, Paulo, just go to Forex.Today. Okay, so this looks better if I was going to, you know, if I was going to sell pound one more time, it would be off of here. Okay, and then there's a psych level in there. So probably even just now, right, off the psych level. So when you're trading a psych level, you want to play sort of the, so in this case, it's 4600 to 4620. Let me zoom in. Okay, I'm trying to catch this for you. See how it's playing this? Plus right above it, it's the roll reversal. Okay. You see it? This red line right here is 00000. I wish we had a press conference going though. I want to see Mark Carnier. I swear it said it was going to be at 12 GMT. But in the end, Well, except for the singing, right, Paulo? All right, so things are slowing down, and I preferred if the press conference was going. Okay, I'm going to drop into the 1 minute now. Remember, this is it right here. This line right here. Okay, that's where you want to sell, right? And it's rolling over right now. Could be interesting. Boop, boop. Shields up, red alert. Boop, boop, boop. Romulan's off the pole bow. Wakey, wakey. All right, so then there must just be a malfunction at the junction. Nice. Look, that's a 10-pip move, 12-pip move already. Hopefully we can break through these wicks. And there's typically a lot of stop losses just below 80. So if we can get a little bit lower, we're at 77. We can get it just a little bit lower than these wicks, then there's going to be stop losses and it's just going to go red, red, right? Red, red, red. Not as people are selling, but as stops are being hit. And everyone long will suddenly put short to offset their positions, right? Dollar sort of back at its support area. Okay, here it comes. If we hit some stops, it's gonna be double the size of the previous one. Paulo, when I say if you're going to play the psych level, like, look, Paulo, this is down. No one in their right mind would buy this. B, the news I read to you shows everything bearish for the Great British Pound. 3, I went through 4 different pairs and found one pair that looked more reasonable to sell than all the other ones. And then 4, we looked at fib retracement roll reversals and the psych level all as resistance. This is pound Swissy. I may have called it pissy. Pound Swissy. So yeah, it's one of these things where if you didn't understand that, you shouldn't be trading this. Right? Everything I said should have been interpreted as, sell. But if you don't get that, you really need to stop trading. And I'm not being facetious, and I'm not being mean, and I'm not being rude, I'm not trying to insult you, I'm trying to save your money. Okay. That doesn't make me a bad guy. So I'm worried, though, that we've traded the news, but we haven't got the press conference, or their link is wrong. But I got this link from their website. It's still in preview mode. Yeah, Paulo says, I'm not trading, I'm learning. Cool. Well, okay. So anyways, there's no follow through right now because we only know what we anticipated anyways. But I'd like to see Carney can come out and just say something like blah blah blah, and the market can move. So, all right, wait for. Hopefully, we can start hitting some stops in here. Like I said, there's generally a lot of stop placement just under 80. So if this turns red, a little bit red, a little bit red, then hit a stop, then hit another stop, which turns it redder, hits another stop, which turns it redder, which makes other people panic and they get out, and which makes this redder, then gets a couple new people shorting. And we go right from this 75 where we're down already 65, I think now. Should very quickly head down to the midpoint cycle level at 50, which is here. And there, see right there. That's stops being hit. That's not people getting in, that's people getting out of their long positions. Okay. Now we played this little low. So let's see if we can get some bears in. It's going to come down to 50 and then down to the weekly central. Okay, we got to get through all these little micro levels of support. Okay, we're through that one. Just a little bit lower low. Should come down pretty easily now to this red line, which is the midpoint psych. Let me throw up price so you can see it, right? So we've gone all the way from this short at 95. We're at 59 now. Yeah, you're welcome. Is that what it is, Alan? The actual speech isn't for another 20 minutes? Well, I'm going to be over at Forex.Today for that. But at least we snuck in, 40 pip scalp. Funny thing is, pound dollar and pound yen, like I said earlier, didn't really move much at all. Even if they did, there would have been a little bit higher risk. So I'm looking at pound yen, still kind of a triple bottomish thing. And that pound dollar, like I said, you would have had to have sold it in the middle of a range. That just sounds stupid, even on a good day, right? What kind of idiot sells it in the middle of a range? But anyways, thank you, Alan. Oh, it started. Oh! Look, they showed something. Well, in that case, maybe I'll move people over from Forex.Today since we got this running anyways. Are you guys okay if we cover it here? Everybody? Hello? Give me a booyah. Yeah. No problem. Okay, we got to get through this little micro. I'm surprised it's taken this long, actually. Leon, that's a big booyah. All right. Well, let me work on getting the Forex.Today people. over here. Oh, the press is moving in. Ooh, that's so exciting. I saw somebody. I tried so hard not to lose it all. In the end, it doesn't even look at their stupid technology. How dumb. We're the Bank of England, but we don't have a responsive web page. Yeah, great. They heard they were supposed to be transparent, so they made the windows larger. Come on, guys. Silly Bank of England. Okay, so people, I wonder, look, there's boom. Now we're 15 down on the scale. Congratulations, my friends. Nice little scalp, huh? There you go. Right, beautifully to your mom. I'll leave the video kind of over there. Seems pretty easy, huh? Okay. People are coming in. I got to turn my sound on. Good scalp, though. Okay, where's the sound? Man, where's the sound?
Yesterday's decision was taken amid sluggish global growth, turbulent financial markets, and the ongoing resistance of the UK system and private domestic demand. Those statements explain the difference between outlook then recession, now for continued expansion. Let me expand. Global growth has slowed again over the past few months. Emerging economies slowed further, economy grew less than expected. Global growth is now expected to remain around 1 percentage point below its past averages this year, despite the boost to real incomes in advanced economies from lower oil prices and the easing of fiscal policy in the United States and the euro area. Further ahead, growth in the UK's main trading partners is expected to remain well below past averages. Balance of steady growth in advanced economies and an eventual slow, modest recovery in emerging markets. Time, the MPC had identified downside risks to the global economy from deteriorating prospects in emerging markets. And these include the ongoing challenges of economic balance in China, the impact of lower exports for commodity traders, and reversal of capital flows and marketing of financial conditions. As these risks have begun to materialize, global financial conditions have deteriorated notably, including widespread falls in advanced economy equities, rises in corporate bond spreads, and increases in market volatility. All of these developments pose downside risk growth in the United Kingdom via trade, financial, and confidence channels. The outlook for trade is particularly challenging, with net exports expected to drive UK growth over the forecast period. However, there are three domestic offsets to the tightening of global financial conditions. First, sterling has fallen 3.5% since November. It's the largest decline between inflation reports and the Second, the yield curve has fallen further, with UK 10-year rates down 25 basis points since November. And third, the UK financial system is resilient. In this last regard, it's important to recall major UK banks are well capitalized. Take into account results of the Bank of England's 2015 stress test, a test which focused on a much more severe shock to Chinese emerging market growth, partly higher spikes in market volatility, and fall in risky asset prices.
Can you guys hear okay?
This means that banks are much less likely to amplify such stresses and are likely to be much more able to continue lending to the economy, even if global conditions deteriorate further. The resilience of the UK financial system is matched by the resilience of UK private domestic demand. Despite the slight slowing in the pace of UK growth last year, and the prospects for a referendum this year on UK's membership of the European Union, indicators of household and business confidence currently remain robust. After 7 lean years, real incomes picked up sharply last year, supported by both record high employment and lower food and energy prices, and they're expected to grow solidly going forward. Business investment growth has been well above its pre-crisis average, with firms investing to meet rising demand while benefiting from favorable credit conditions. With the understandable exception of the oil and gas sector, such strong growth is expected to continue given high returns on capital and limited spare capacity. Overall, given global weakness, somewhat more modest wage growth, and accelerating fiscal consolidation, the overall pace of growth in the United Kingdom is expected to dip below past averages this year before returning to around 2.5% thereafter, as a tighter labor market and rising productivity support real incomes and consumption, as well as spurring business investment. This more modest profile for demand compared with our last report is matched by a lower but still solid path for supply growth. Developments on the supply side of the economy reflect an economy that's moving from a period of exceptionally rapid employment growth and unusually slow productivity growth to one where growth in both reverts to more normal and arguably sustainable rates. With 1.5 million jobs created over the past 3 years, unemployment has fallen 3 percentage points to around 5%. Job vacancies relative to unemployment are now back at pre-crisis levels, and people are moving between jobs more frequently.
So I'll give you his actual report. It's right here.
Pre-crisis downward trend, reflecting higher job security and a further normalization of working patterns. Now, as labor supply growth has slowed, productivity growth has picked up, with last year's hourly productivity growth probably the fastest in the past 4 years. The MPC expects potential supply growth to rise steadily over the forecast, as this pickup in structural productivity largely offsets the reversion of labor supply growth to more normal rates. So what does this all mean for inflation? Well, as I said,
What does it all mean, Basil?
by far the most important reason for low inflation remains the sharp fall in commodity prices globally. Since our November report, oil is down by another third. The scale of the most recent commodity price falls means that CPI inflation is likely to remain low for much of this year. However, with momentum from private demand expected to eliminate the economy's margin of spare capacity this year, domestic cost growth should rise. And as the drag from the external factors wanes, increasing domestic
He mentioned me.
more than sufficient to return inflation to the 2% target by the start of 2018. Now, in the near term, the MPC judges that the risks to inflation lie to the downside, and that reflects the possibility that wage pressure takes a little longer to build following a period of low headline inflation. However, the mechanical return to higher inflation rates, as past falls in energy prices drop from the annual comparison, should in time reduce this risk. Moreover, the MPC judges that inflation expectations remain well anchored, though it's watchful for signs that low inflation is having more persistent second-round effects. Returning inflation to target requires balancing the protracted drags from sterling's past appreciation and lower commodity prices with expected increases in domestic cost growth. Fully offsetting the drag on inflation from external factors over the short term would involve too rapid an acceleration in domestic costs, one that would risk being unsustainable and generate undesirable volatility in output and employment. And given these considerations, the MPC is setting policy to return inflation to target in around 2 years and to keep it there in absence of further shocks.
Where is he going to get the inflation?
The case we set out with the inflation report today, and it's a central case that's conditioned on a market path for bank rate that was around 20 basis points higher.
Chinese yuan is quite strong at the moment.
CPI inflation is likely to exceed the 2% target slightly at the 2-year point and then rise further above it. As a consequence, the MPC judges it more likely than not that the bank rate will need to rise over the forecast period. Now, as always, there are upside and downside risks to inflation. It could be higher if weakness in wage growth reflects temporary factors that are obscuring the underlying tightness in the labor market.
It's pound Swissy.
Inflation could be lower if global risks crystallize more.
I didn't like the pound dollar and pound yen. This was better. We already made 50 pips on this.
Contribute to weaker wage growth. In any event, the MPC stands ready to act to ensure inflation remains likely to return to the...
This is a sell zone, guys, up in here. Sell zone, sell zone.
To conclude, as one of the most open economies in the world, the UK cannot help but be affected by an unforgiving global environment and sustained financial market turbulence. However, our prospects for continued solid expansion are underpinned by the resilience that has been built over
Okay, see, 618, 618.
a labor market with record high employment, strong private domestic demand reflecting improved private sector balance sheets, rising productivity and robust confidence, and a financial system that is capitalized for severe emerging market stress so that it can continue to serve the real economy here. And with that, Manoush, Ben, and I would be pleased to answer your questions.
Could you please give your name and organisation as usual, and be very grateful if you could restrict it to one first time so we can get round again. Ed, please.
Pound Swissy.
Thank you. Ed Conway from Sky News. Governor, the markets are now pricing in the possibility, a kind of about 30% possibility of there being a rate cut rather than a hike in the next year. You said repeatedly that you feel that the next move is likely to be up rather than down. Do you still stand by that?
Oh, absolutely. And the whole MPC stands by that. We've just released our forecast, which, as I mentioned in my opening remarks, is conditioned on a path, a market path of interest rates. And as I think you know, Ed, we use as a convention, we use a 15-day average. So we didn't use last night's market path. We used the 15-day average up to finalizing the forecast. And that 15-day average of the path of rates is rates staying at current levels for a little while longer and then gradually increasing farther out over the horizon. And in using that market forecast, based on our central view of
We're back. 50 pips down, 50 pips up. Psych level, psych level.
tightening in that market path that we used in order to do what the MPC has been very clear about is its objective, which is to return inflation to target in around 2 years and to keep it there, not to have an overshoot. And the reason why that's particularly important is right now we have this circumstance which we've been going through for most of the past year, a little more than the past year, where we have these disinflationary or deflationary pressures coming in from abroad, and we have a gradual build in domestic costs. Eventually, those disinflationary pressures from abroad will wane. The domestic cost pressures are likely to sustain, if not build, and we need to time this and balance the two to not just bring inflation back to target, but to do so.
So what he's saying, it's not us, it's them.
Again, and we said in the minutes and in the monetary policy summary, and it was clear in the letter to the Chancellor, the view is that more likely than not, the next move in rates is up, and that is consistent with the forecast, yes. Thanks.
So we scalped this for 50 pips short, and then we're all the way back.
You've made attempts in the past to manage expectations to the likely path of interest rates. I wonder the degree to which you feel that perhaps your credibility has been damaged when you give guidance on interest rates now. Do you think the British public takes your guidance as seriously as perhaps it did?
Still a sell zone, still a sell zone.
In terms of the guidance that we've given over the course of the last 2.5 years, the first thing we did was to give guidance to help secure the recovery. So we've always given guidance that's state contingent, not time contingent. So we haven't given preset timetables for rate changes. We've said that these certain circumstances are either necessary conditions to even think about moving rates in order to achieve the inflation target. So we gave guidance to help secure the recovery, initially contingent that we wouldn't even begin to think about moving rates until unemployment had fallen to a certain level. That had an effect. And we know that from surveys, and we know that from the performance of the economy. The worst that can be said about that guidance is that
I'm watching other currencies too, and this is still one of the best ones to be watching.
Secondly, we gave guidance in terms of the overall shape of the likely path of interest rates once they began to rise, and that's guidance we gave about 2 years ago. That rates, when
the best looking chart actually is Euro Yen.
Time came, would likely to rise to a limited extent and at a gradual pace. That guidance is now so familiar, it's sort of part of the furniture. But it's helpful because we know from going around the country and talking to businesses and meeting with households that people understand both that the likely orientation of rates is rates are going to increase as the expansion progresses, but they're not going to rocket as they had to do in the past, and that we'll manage this process.
Look at this move from up here from 13 back down to 80. Just look at that, 40 pips in just 3 minutes.
Guidance around the asset purchase facility and when how we would use our various instruments of monetary policy, and that's useful guidance for those who.
Hey Nuno, what's up, buddy?
And then what we've been clear on, and I think I've been clear on, others have slight different weighting on different factors, are what are the broad indicators of that influence me in terms of determining the stance of policy. And so whether it was last summer where I set out a range of indicators around domestic costs, around core inflation, around momentum in the economy relative to the capacity economy. Those are the indicators that help inform when, at least in my opinion, it would become the right time to raise interest rates. And by setting out those conditions, again, those conditions about the state of the economy, not about the calendar, conditions about the state of the economy, people can form a view on whether or not we're going to move policy. And what you saw, for example, over the course of the fall, as global conditions.
Is everything okay, Nuno? I haven't seen your trading ideas for quite a few days. Hope everything is all right, man.
It picked up, but a little less rapidly than expected. Market participants and others, yourself, began to push out the date and when we might raise interest rates. That's exactly what we want to happen because that's exactly the way we treat policy. We're not going to tie our hands ever to raise interest rates or adjust policy in any way, shape, or form to a certain date. But we are trying to inform the markets and, most importantly, households and businesses in this country what's likely to happen on rates. And I'll finish with this. In a situation where we alternate with the United States here, but where we have had the strongest recovery in the advanced world now over the course of the last 3 years, and where we've been steadily, people have been steadily finding work, and the job market has been tightening. All in an environment of great global uncertainty and difficulty. In that environment,
No, January 28th was the last one.
in my opinion, for households and businesses to recognize that it's more likely than not that rates are going to go up, and to plan their affairs accordingly, particularly since, while there's been tremendous progress, British households have done a great job in paying down debt, they are still relatively indebted. And we want to make sure that the collective we do not repeat the mistakes of the past of getting too indebted and then getting shocked by movements on rates. So no, I don't think we have anything to explain on that.
Ben, and then David.
Ben Chu from the Independent. Governor, you and the MPC both make the point that low headline inflation seems to have been putting some downward pressure on wage growth because people have moderated their wage demands, and you also talk about being watchful of the risk of second round effects. You don't use the D word in your remarks, but these are precisely the kind of deflationary dynamics that some have feared, domestically generated deflationary dynamics that some have pointed to in the past. Although it's clearly not your central case, is it fair to say that these risks now loom a little larger in the bank's calculations than they did previously?
Well, I think what has changed is that we're watchful for these issues, as we should be all the time, and you're right to raise them. What has changed is that we've incorporated some of these dynamics into the forecast, and so you do see a more modest pickup in wages than previously, but still a notable pickup in wages. And that's a product of the fact that we have a tight labor market, unemployment at 5.1%, more people employed as a proportion of the population than since records began to be held, and many other signs of normalization of this labor market. So we have a tight labor market, and we think we have productivity growth starting to pick up, which should support those wage gains. But we have incorporated more persistence of a slower pickup, I should say, in terms of wages because of some of these effects. Now, in terms of our watching, it's not just a question of looking at observed wages and running econometrics and adjusting our forecasts mechanically. We also go out and we use our agency network and talk to businesses across this country. And they've precisely asked this question about the impact of low inflation on the wage setting process. The answer from the agents and from the businesses and collectively and individually as we meet with them is it's affecting them a bit, but it's not dominating. So I think we've got a balanced approach to this. It clearly is something we're watching.
Really?
And we'll continue to watch. And I'll finish with this, is we have to be conscious, though, that there are other factors that
Weird. I don't have that data.
pick up a little more slowly than expected. The composition of employment is one example. It's possible as well, open to the possibility, it's not our central view, it's possible there's
Weird. All right, cool. Well, good.
And it could be just the lagged effects of slower productivity growth feeding through on wages. So we're aware of all those things. You know as much as we do about the labor market. That's the point of bringing all these issues to the surface.
David Smith, Sunday Times. Can I just follow up on that? Two things about wages. One is, do you expect the national living wage to have any impact on earnings growth in the coming months? And secondly, just to elaborate slightly on, when does watchfulness turn into monetary policy action? If wages were weak enough, might that bring a monetary policy response?
Yeah. Okay. On the first, in terms of the national living wage, we see, and our treatment of this has been not just to look at those who are directly affected by the national living wage, but also those who are close to those wages. In other words, our expectation is that businesses wouldn't just, obviously they're going to abide by the national living wage, but if
it retests 46, are you going to sell it?
pay grade up against somebody at the next pay grade, that there would also be some increase there as well. Going across the numbers of people who are directly affected, indirectly affected by this, you get into the orders of magnitude of probably 5 or 6 million workers across this country, including the indirect effect, the second effect. Overall, we see the net impact of this on wages and inflation of about 10 basis points ultimately.
I'd like to point out that nothing's actually happened, right? Where we started around this 46.20, we shorted at the retracement back to 46, went down to the daily S2. Actually, the weekly was what we wanted, and then flipped back up, went back to where we were, and now is heading back down.
The minimum wage, and we do recognize that, so there will be some distributional things there. In terms of watchfulness to action, I mean, the action part is determined by all the factors.
Oh, by the way, Joe, you're on YouTube. Just click on the Forex.Today YouTube channel icon, and the video's there.
And it's taking a little longer, but it's directionally happening. Our basic expectation is that domestic costs are going to continue to grow.
I hope everyone subscribed to the channel. That way, when you get it, when a video is posted, you get updated.
Inflation in the medium term. This is the point where I have to say, of course, there will be other shocks that happen from time to time, and we'll have to react to those shocks when they do come. I do have to say that, and that is reality. So I wouldn't isolate this as it's important that we surface it. It's important that we've incorporated it into our forecast, but I wouldn't give it a sort of totemic status that it is the determinant of the passive policy. That would be overweighting both of what's happened and the reality of the inflation process, which is there are many factors that determine inflation.
Emily, and then Kamal.
Emily Cadman, Financial Times. Governor, turning to credit growth and household expectations, if households take your guidance that rates are staying where they are for a considerable amount of time and start to pile into credit, would you be worried? And if so, at what level would you start to get worried?
Well, first thing is the guidance is, I mean, we have a forecast based on a certain set of dynamics. You have guidance around certain indicators that would potentially shift the stance of policy. I won't go through them again. That's the guidance. It's not you use the time. It's not what the guidance is. Okay. So I feel I have to reinforce that. In terms of credit growth from the MPC's perspective, we're obviously focused on the strength of domestic consumption. It is the core, as is almost always the case, the core driver of growth in the economy. We do see the savings rate coming down that's our expectation. The savings rate would come down over the course of the forecast. That there would be credit growth in aggregate that is around or slightly above the pace of nominal GDP growth. But that's in aggregate. You have much sharper consumer credit growth, which is principally being driven by growth.
Yeah, shoot, Nuno. I'm in the back office at Forex.Today, and I don't see those posts. I'm not complaining. I was just worried about you. That's all I'm trying to say. So I'm glad you're all right.
More broadly, the FTC takes a direct interest in this to ensure that risks of financial stability aren't increasing. And I'll finish with this. One of the things we do is we meet from time to time the MPC and the FPC on issues of mutual interest. This is one of them, and in fact, the box in the inflation report, which we can talk about, goes through some of these dynamics, and that is something which captures a discussion that the FPC and the MPC had. The assignment of responsibility starts with the FPC, though, in terms of the vulnerabilities.
Hey, I'd take a screenshot. I'd love to try to figure out what's going on.
Governor Kamal Ahmed from the BBC. it now looks clear that the government is very keen on a referendum on Britain remaining in or leaving the European Union this year. How is that playing into the MPC's considerations about the trajectory of growth for the UK economy? And in particular, could you give us the thoughts of the MPCs and yourself about the strength or otherwise of sterling, or the impact of sterling, if Britain were to leave the European Union?
Well, in terms of the way we conduct our forecast,
Here we go.
events, major political events, whether it's a general election or a Scottish referendum or the EU referendum, we assume the status quo, and we don't. You wouldn't expect us to speculate on outcomes or alternate projections associated with different outcomes. Now, that doesn't mean those political events don't affect the forecast, but the way they affect the forecast is through how they impact asset prices, including the exchange rate, and how they affect household and business confidence. So what we do in the forecast, obviously, is we take asset prices where they are, and we take those confidence indicators, which at present, for the latter, there's not yet a big risk premium built into business and household confidence around the referendum.
Hey, what's going on, Colin?
Market, and it's observed in the report that there has been some buying and protection, if you will, around.
Okay, coming back to the psych level, 4600, not far up there.
Around sterling, and particularly around cable, that have moved notably since December, consistent with the existence of a referendum. We don't have a forecast for sterling, period. And we certainly don't have a forecast for sterling in the event of a political event on which we're not conditioning our forecast. So I'll leave it at that.
Larry Elliott of The Guardian. Governor, earlier you alluded to your Lincoln speech where you said that the rate decision would come into sharper focus around the turn of the year. Clearly, the picture's got a bit blurred around the turn of the year. And I just wondered when you now think the rate decision is going to come back into sharper focus again, because if guidance is going to mean anything, people have to have some idea about what the bank's thinking is.
Actually, Larry, I think the point of that turn of phrase, which was part of a speech that laid out a whole framework in terms of the dynamics of the inflation process and those elements of, or those indicators of inflation, aside from having a chunk of history about the Magna Carta, but we'll set that to one side. The point of that was to give a sense of how those dynamics would affect inflation and how we would potentially react. And given our forecast at the time, given the bank's forecast at the time, when those indicators based on that forecast and the forecast that came out in August, when those indicators would be in the region where that decision would get more difficult. Okay, comes into sharper relief, become more difficult, or become quite easy. The decision came into sharper relief, from my perspective, came into sharper relief. It was quite an easy decision. It was, the decision is whether or not to raise interest rates. It was an easy decision not to raise it. Now is not the time to raise.
So does everyone click thumbs up? Does everyone click like on the page? Doing these special events from time to time is all right by you? Let me know. Give me some feedback by giving a like, huh?
Using up slack, but it's still a bit more to be done there. And core inflation has, well, it's picked up, hasn't picked up quite enough, and that's a product of probably the persistence of exchange rate pass-through and a few other factors internationally. But the value of that guidance is to give a sense of how we will react to events. Everyone in this room will have a slightly different view, in some cases, markedly different view of the outlook for the economy.
Hot air balloon rides in Orlando? That sounds awesome!
And we can give a general sense of where things are likely to happen. We have a view, our forecast today, in effect, says that we think that if our central view of the outlook for the economy comes to pass, we will need to raise interest rates to a limited degree and at a gradual pace in order to keep inflation, not just get it to target, but to keep it there. If you have a radically different view of the economy, you can form a different perspective on the path of rates. What we can assure you is that when it comes time to make each decision, we won't be bound by something we've said in the past. We'll make a decision based on achieving that target. Thanks.
Yeah, only 27 people like it. Well, next time I'm in Orlando, I'll look you up.
That is welcome to those of us who are worried about the downside risk, in particular the financial market risks outlined in the inflation report box that the FBC and the MPC have.
All right, so we're locking up on that old support level to the left. He says, was he Manchester?
In other words, what is the substance of what you effectively did in that last speech?
Well, I think
what?
One is the substance of what I said in the last speech was to give an accounting of how the economy had performed relative to some criteria that I had set out 6 months earlier. And you can judge how well it's accounted for, but and by giving that accounting.
No, you're watching on YouTube, right? So the YouTube page, you click the thumbs up thing.
My reaction function, to use the technical term, how I would be expected to react depending on how the economy performs. The second thing.
Okay, moving on down. See if we can get back down to the weekly.
In effect, provides guidance, provides a perspective, provides more information about the current reaction function of the MPC as a whole, not just myself. And the third thing is, I in terms of the overall performance of, if you look at short rates in this economy, at a time of great volatility. I mean, it is not an unchanged.
So what's the VIP hot air balloon ride like?
Uncertainty in terms of the real economy, particularly around the supply side, a point that Ben Broadbent has made far more eloquently and to a much better grounding than I will.
Sure, no.
At a time of all that, if you look at the volatility of short sterling, if you look at your forward volatility, it's half of what it was in the 10 years preceding my arrival at this institution. It has come down. Now, you do want volatility because there are going to be shocks and you don't know. So we have provided guidance, we have provided frameworks, we have provided more information. We are obviously constantly, as a committee and as individuals, looking for better ways to provide that information. But there has been a movement down. There always will be volatility in financial markets. There always will be events that move around the likely path of monetary policy, whether it's in the UK, the US, the Euro area, China. And we have to react to it. All we can do is inform as best as we can, not just the financial markets, but in a way that's digestible, very importantly, in my view, for the general public, those who we really serve, all of us really serve, a way that they can understand both likely paths and what can change those paths.
Phil, and then Hugo.
Phil Aldrich at the Times. There seems to be a contradiction in the inflation report that I hope you could resolve.
Well, I'm sure Dr. Broadbent would be very happy.
Ben, one for you then. But in it you talk about spare capacity being eliminated by the end of this year, and then if you look at the projections of the market yield curve, which obviously in the report isn't as severe as it is today, that seems to suggest that.
There's probably going to be a few bulls in here. I think they're eyeballing this kind of stuff. So if it can get a little bit below that, there's probably a lot of stops and it'll head on down. But I think some bulls are going to take this. Right, it's a 50%, right? Or do I have to, from this high to that low, that's 50% plus this old support?
At all. And indeed,
even to the extent there was a reasonable correlation prior to the financial crisis, even then it wasn't the only thing. Inflation mattered, obviously, inflation expectations and so forth. But I would say not just since the financial crisis, but even before, there have been big variations, generally declines, in what you might call the neutral rate of interest. And we have to take those into account. We could have had a zero output gap 20 years ago and the level of interest rate.
It's funny the difference in accents, huh? The guys in the central bank sound like they went to fancy prep schools, right? Upper class, and then the reporters sound like they're that they were educated in a bar.
On the output gap, that was core guidance part 2. Was a lot to do with spec capacity.
Not at all. Let's reiterate what the governor said a moment ago. Read first of all what guidance actually said. Okay, it said that the committee judges that the path of interest rates that is likely to be necessary to meet our objectives will be shallower than it was in the past and end up at a lower level. That's what it said. It said no more than that. It certainly said nothing time specific.
How's your mum?
The earlier phase had unemployment in it, but that wasn't.
Whoa.
The referendum, if I may, and particularly on
Come on, Bears! Come on, Bears! Come on, Bears! Come on, Bears!
notes that the referendum presents a downside risk in the near term to business spending, yet goes on to say that
Oh, without a doubt.
I'm just wondering how real you think this risk is and whether you
Well, except we don't have an upper class. But where I live, we have some hillbillies, but mostly rednecks. Do you know the difference between a redneck and a hillbilly?
We'll see in terms of what we assume based on the existing surveys and the relationship of those surveys to.
Yeah, a redneck will kill you, but a hillbilly will keep you.
Little, in our judgment, relatively little spare capacity in the economy. We expect, as you've noted, a pretty smart rate of growth of business investment, certainly relative to historic growth rates. Think growth rates in the 6% per annum area versus kind of 2.5% per annum historic growth rates. We'll update that as events transpire.
All right, the moment of truth. I think if we can get enough bears, I think there's stops just below this. And just like we did last time, right in here. I talked about it in here when we were short off the 46. And I said, if we can just get a little lower, the candles are going to get big and red because we'll be hitting stops, bullish stops, right? So all of a sudden, red, those are all stops being hit. Then he blabbered something all the way back. We're kind of in that same scenario now where if we can just get a little bit lower, it's just going to go red as it cascades off of stop losses being triggered. This is pissy. Pound Swissy. Pound Swiss franc.
The otherwise would be to potentially wait in.
I looked at pound dollar, didn't like the setup. I looked at pound yen, didn't like the setup. I looked at pound Aussie, didn't like the setup. But I looked at pound Swissy and it was great.
They emphasize the near-term downside risks a lot, which obviously has pushed back prospect for an interest rate increase. But might the medium-term risks, which makes now inflation come back to the target quicker, make later?
Well, Colin, I live on the coast of Portugal.
Faster rate increases when they do.
Oh no, wait, that's you.
These downside risks don't materialize.
In terms of the path with which we set policy, we look at the mode as opposed to the mean. So we haven't incorporated the downside risks into our central projection. So we're looking at the most likely measured as the mode as opposed to the mean. And we've always done that by convention.
Is Cardi talking about using the mode versus the mean? That's awesome.
It's useful to have the discussion, but we talked about this, assumption that wage growth is shallower. The pickup in wage growth is shallower than we previously had expected because of some sort of some elements of second round effects, early elements.
It looks like maybe a 618, right? 618 for the bulls. I'd like to see it stay short though. Let me move the projection down. Like to keep it bearish.
Policy. Now, to go back to the earlier discussion, Larry's and other people's question, by laying out some of the elements that would influence our reaction to that, if you start to see those things develop, if unit labor costs pick up more smartly, if core inflation, if there's less pass-through from the past appreciation of sterling, for example, and core inflation rises more rapidly, or just the economy grows more rapidly than we expect, well, then all things being equal, one would expect that policy would be tighter.
Was that right? You need to go for a hot air balloon ride. Orlando and then Vegas, huh? Golfing trip or what?
And the risk that low inflation becomes entrenched in wages.
Or I guess Disney World and Vegas are just things to do while you're in America, huh?
But when does
Sounds like a good trip.
start to become a worry for the committee? And what is your message for employees and employers as they start to negotiate the wage round for this year?
Okay, I'll ask Ben too. Now, just to reiterate what the government has said, I mean, what we did in the forecast was make a small adjustment for what we perceive probably as a small effect, negative, but not that big, of low rates of inflation on actual pay settlements. Now, the pay data themselves are pretty volatile with all sorts of things that influence them. So it's not possible to say, with certainty, this is what.
Someone took the 618, huh? If you're a bull, you have this measured like a 618. I hope not. That'd be a bloody mess. US dollar falling. Chinese yuan still pretty strong.
People deferring consumption. I mean, a whole host of questions about that simply haven't come true. So it is something we watch. We have obviously a responsibility to watch.
If you're watching USD CAD, the 4-hour and daily are ready to head north. I mean, for a week. I just don't know if we have the setup for it yet, but it'd be great if Canadian dollar got weak on us. That means oil price is down, eh?
Just the international context a little bit more here. Clearly from the minutes, the committee spent a lot of time thinking about the volatility and risk.
Oh, Colin, wow. 2 awesome trips, huh? Good for you, man. That sounds cool.
Particularly secondary bond markets. I wonder to what extent the committee is taking this into consideration.
Well, don't forget, tomorrow we have non-farm payrolls and Canadian jobs reports. I'm over at fxstreet.com tomorrow to trade non-farm payrolls live if you want to attend. Wow. There's lots of people I'd love to visit in Portugal, and sailing a boat in the Portuguese winds would be like a privilege reserved only for kings. So that would be a great honor. I'd have to go visit a winery or two, though, as well. Wow, that sounds so good. Sailing in the Portuguese winds. Man, that sounds like heaven.
Dynamic.
All right, good. We got the Bears back in the game. Thank goodness for that. Because I'm a trend trader. I don't want to be stuck in the range. I want a breakout.
I believe, we believe that they stem from concerns about the growth trajectories in China and major emerging markets and a potential amplification of that to advanced economies and questions in terms of the ability of policy to respond to those concerns. The distinctions we would make is that we're in a very different position, as I tried to do at the outset, than we were 7 years ago in terms of both the health of the system, of the financial system, the improvement in balance sheets, corporate and personal, and the amount of momentum, sustainable momentum that is there in the economy. So, Jeff, we obviously have to.
Wow, that sounds so good, Colin. And are you still running your hotel or your B&B? All right, come on. Got to get through the midpoint psych level now. Whoop, whoop, whoop. Oh, I thought you had a professional sort of small hotel or something. Oh, so okay, I see what you're saying. Well, that's cool. Man, seafood in Portugal in a small village. It sounds good. That sounds really good.
As you well know, there are concerns about market liquidity, partly attributed to changes in regulation around the leverage ratio, but also around structural changes in the way markets operate, particularly the rise in high-frequency trading and the fact that that the structure of some of these markets has changed. Now, the FPC has an extensive stream of work on various aspects of this, and we are
Right on, Colin. All right, we got a breakthrough. Woo, come on. Keep it going, Bubba. So let me describe what's happened over the last couple of hours. We dropped 50 pips, we rose 50 pips, and we're on our way down for the 50 pips. Think about it this way. Trillions of dollars of exchanged hands. Fortunes have been made and lost, yet nothing happened.
We did an assessment of the overall degree of slack in the economy. We do a sort of periodic so-called supply stock take. And so we looked pretty hard at the labor market as a whole. We made a couple of determinations in that. One is that we took down a bit our expectations. And we also signaled.
Well, I'm telling you guys, if we can get 10 guys together to do a trading event in Portugal, 10 or 12 guys in a conference room with laptops trading for 8 hours, that'll cover the costs of the trip. Wouldn't be much per person. That's what we're going to be doing that in about 6 weeks. We're going to be doing something like that in Johannesburg, South Africa.
And in fact, as you rightly point out, over the course of the forecast, we expect on average that the unemployment rate would fall below 5%, below that current estimate of the natural rate. Now, we will be very interested to see, as everyone will, in terms of how wage costs evolve if this comes to pass, and also how job matching and job churn and other indicators evolve. There are reasonable arguments on both sides of this to suggest that the natural rate or the NAIRU, different concept but similar, has actually fallen in this economy over the course of the last several years because of a series of reforms to labor markets and the nature of work and other factors. We're alive to that possibility. For the purposes of this forecast, we've made a judgment to which we all adhere.
All right. Well, I'm not hearing any new information from him now. I think we've heard everything. Let me check Forex.Today. Do we have anything at 8:30 news-wise? Just weekly jobless claims, no big deal, right?
If we look at the market forecast at the moment, rates, the first rate move is seen for mid-2018 now, so I'm pricing up
Yeah. Nothing, huh?
Are you worried you become the first governor since, I think, 1944 to 1949?
Yeah, there's no target because it's not, in my book, it's not a real trade. We're just trading against the price action of the event. But I don't think we've learned anything new, so there isn't new information to create a new trend out of. So, if this jumped 300 pips in one or dropped 300 pips because of something new happened, some sort of change in policy was announced or would be interpreted to be announced in the future, then I would feel differently, right? I'd say, wow, look at that. Pound is, crushed, right? And the pound is falling. Then I'd get all, giddy and excited and say, oh, well, sell it hard, let's just let it roll, let it run, but let it run. So before the event happened, we sold, our trade plan was sell it off I went through, I did analysis on a few different pairs, and I did some fundamentals and whatever, and we had a pretty easy sell here off of 46, right? Lower low, lower high, sell at the psych level, which is a level of resistance, and it very easily and without much drama came down, and our target was, weekly central basically, right? So it went a little farther. Okay, whatever. Pretty straightforward, 50 pips. Then there's sort of the counter revolution here, the news coming out and people just sort of reacting, drove it back up. So some counter trend people, but they bought it at the weekly. So if you're a bull, why wouldn't you, right? And then it just kind of, we're here. So target, I don't know. I would say stay short until it makes a higher high, which is probably going to be close to a break-even trade anyways. But look, it's not doing anything. And, even worse, how about this? Probably the best part of the whole event, I'd say today, is how I looked at the pound dollar and saw neutrality. And I said, there's no way I want to trade this in the middle, which was probably a good idea to avoid. And if anything, you bought it there, but I don't know if you would have. I looked at pound yen, and you have to realize sort of pound yen was in this area, and it did go lower, then it went back, and then it came back, and there we are, we're still at that same price. And what was there was a pound Aussie in here, and that didn't look very good, but whatever. I went through several pairs, and pound Swissy looked like the most reasonable because it was less sideways of a chart. Yeah, and this is probably even kicking you out soon. So, so long story short, we laughed, we cried, right? But not a lot learned, and I think we're all going to look to non-farm payrolls tomorrow and Canadian jobs report tomorrow. Watch oil today. We can take a look at oil, right? There's still a pretty strong correlation. If oil goes up, the stock market goes up. If the stock market goes up, it's risk on. But, dollar right now is weak. Yen right now is strong. It feels risk off. it feels like oil wants to come down, right? And then we go into the 4-hour. Look at that oscillator, guys. Holy smokes, eh? That really feels like it wants to come down. Now, there was a buy in here yesterday. Was it yesterday or the day before? But anyways, right off the 618 with the Stokes kicker, 5-8 cross up. Nice, right? Yeah, well, it only went from 30 to 34. But now it feels heavy. Doesn't that feel like heavy crude, like that wants to fall? Daily's already on the way. And look at the top, right? Isn't that the perfect place to sell it? Right? Made a drop, now a lower high, which is, which typically precedes a lower low. Are we going to double bottom back at 27? Are we going to make a lower low? Or are we going to go after 25? If this heads down, ooh, yuck. But it kind of feels like it wants to, doesn't it? I mean, I don't want it, but doesn't that feel like, ugh? That means stock market down. That means yen strong. That means dollar weak. That means commodities down. You're like, oh no. And the stock market, ugh. So let's roll over to the S&P 500, and we got to stay above our line in the sand. And hopefully, it's not like an Obama line in the sand. But yeah, let me know, guys, if you want me to come out, in May or something. Wait, I have finals in May, maybe in April. No, I'm end of April. I don't know. I'm busy, man. Let me know because that just sounds cool. I probably don't have time. Ugh, damn, I wish I had time. Okay, let me go back. That's the wrong one. This is what I wanted to see. And let me go to like daily. And there's my line in the sand. We got to keep it above this stuff, man. That's a real need. And so far, what it did is came up, hit a pivot. This is the S&P 500, right? Okay, bottomed out where it needed to, rallied up where it needed to. Great. Came back, quick retest, quick rally up, and now is currently heading down. So this is a daily chart, and the daily says it wants to drop. That's bad. That's bad. 4-hour wants 4 hours, not so sure, but man, oh man, being below this monthly pivot and having a daily one in the rollover, oy vey. Oh, purple parallel lines? It's this one here. Okay, equidistant channel. Okay, it's not an indicator. It's just something that you draw. Okay, I use it to look for breakouts. Particularly in reversals. Okay, you got that, Alan? So I don't want that to happen, but that's kind of what it feels like it's doing, doesn't it? Kind of too bad, if you ask me. Too bad. So only 50 likes, huh? You want me to do Euro USD? Fine. But in the end, it doesn't even matter. Bum, 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 do, do, do. Do, 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 do. Okay. And based on commitment of traders report, what we see is that this is people just simply getting out of the short position. And, you know, S&P 500 looking like it wants to fall, oil looking like it wants to fall, yen looking like it wants to strengthen. I mean, look at, we just broke 117 on USD Japanese yen. It's all very bad. Yeah, well, Ryan mentions about, yeah, you know, the ECB is funny. I remember at the very, 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 very beginning of the financial crisis back in 2007, the stupid ECB raised interest rates. It was dumbfounding. Even the Bank of England said that the real estate problem was, you know, was a problem for the Yanks. That's how dumb some of these central banks were. And no joke, the ECB raised interest rates, and then I believe it was before the next meeting, then they slashed interest rates. Isn't it funny to do a 180 to just like in panic slash interest rates, and there's not even a meeting scheduled? It wasn't even an event. They're just like, oh my God, we raised interest rates. We used to be cutting interest rates. You know, they're freaking out. It was just like stupid. And for a British banker to say, oh, well, the British banking system isn't involved, you know, in the U.S. economy and the U.S. real estate market. Are you stupid or something? Like what? British banks have no risk on that? Wow. It was just like, it was astonishing and amazing that central bankers were thinking like that everything is domestic. And you know what? Not a lot has changed about that. Like if you know, Carney here talks a lot about external stuff, you know, but you know, the Fed doesn't pay a whole lot of attention to the dollar, and you know, they changed their policy, but like if other countries don't change their policy, what effect does it really have these days? Right? Like the Dow is, you know, the 30 biggest stocks in the United States are supposed to represent, you know, the health of the U.S. economy, except every single one of those companies is a global conglomerate. Doesn't have to reflect anything domestically, right? Just funny. Well, anyways, underwhelming. So tomorrow I'm going to be at fxstreet.com. I hope to see you there. I can get you a registration page if you want. I think it's going to be here. Anyone going to trade the news? Trade the NFP, non-farm payrolls? They don't have it up there yet, so you probably have to go to webinars. There it is. Check it out, guys. The 117th non-farm payrolls. Yeah, that's it. Only the 117th non-farm payrolls. So feel free to register for that. Should be good. And that's a 3-hour webinar. 3-hour webinar. 3-hour webinar. So hopefully I'll see you over there. Again, please subscribe to the Forex.Today YouTube channel. Please give it a like. Yeah. So what is it, May? Is it May going to be my 10th year of non-farm payroll webinars at FX Street? Right? That's crazy, huh? But yeah, I hope to see you there. So without further ado, yeah, maybe a party in Portugal, huh? Maybe I should do it from Spain. Would you guys meet me in Barcelona and maybe we can drive across Spain and back into Portugal? Or do the 120th non-farm payrolls live from FX Street? No, you can't really do that. They're like, what an idiot. You can't just drive. What, are there mountains in Spain? You can't even do that? Too far. I grew up in Canada. I live in the United States. If you can't do a 10-hour drive, then you're a sissy. You can't drive across. It's so stupid, right? You can't drive across Spain and into Portugal from Barcelona. Yeah, you probably can. How long is it? Yeah, why not? Well, how many hours is it? 1,400 clicks? All right, well, we'll stop in the middle. What's in the middle? Madrid? Yeah. We'll stop for some wine. Wine and snails. 10 hours. See, that's easy. Yeah, let's start. Yeah, it's a 12-hour drive. Let's do it. Come on, guys. We'll drive from Barcelona to Madrid, spend the night in Madrid, get back in the car and drive into Portugal. Damn, that would be sweet. It's May. We'll run with the Bulls. We'll do Tomatino. It'll be great. It'll be the best 36 hours. That's right. I had to walk to school that far every single day through the snow. So anyways, boy, that sounds like a killer idea. I should contact FX Street. So anyways, hopefully I'll see you over at 117th edition of Non-Farm Payrolls at FX Street. So anyways, thank you to Forex.Today. My name is Wayne McDonell. I'm with TradersWay.com. Yeah, we're an ECN that's not going to screw you over. So why don't you open up a demo account, and if you like us, one day when you feel confident in your trading, maybe you'll open up a live account. We'll be your trading partner. How does that sound? So peace on earth. May the pips be with you. May your profits be above average. Cheers.